Hi, we've gone through techniques of capital budgeting by now, specifically NPV, IRR, payback period and so on. And we know that all of these techniques rely on cash inflows and cash outflows. Till now we've looked at cases in which the cash flows, whether inflows or outflows, were readily calculated and given to you. But actually when it comes to estimation of project cash flows or calculation of project cash flows, we've got to peep into the future and then try and estimate these cash flows. There are a few principles, cornerstone principles that we've got to take care of when we get to cash flow estimation. So, I am taking up a case through which I should be able to lay down the principles of cash flow estimation. So, let me read out this case and explain the case along, and then we get through the solution. Right. So, this goes as follows. India Pharma Limited is engaged in the manufacture of pharmaceuticals. The company was established in 1998 and has registered a steady growth in sales since then. Presently, the company manufactures 16 products and has an annual turnover of rupees 2,200 million. The company is considering the manufacture of a new antibiotic preparation casein, for which the following information has been gathered. So, we are looking at launching of a new product. Essentially, that is the decision that we've got to take. Casein is expected to have a product life cycle of 5 years, and thereafter it would be withdrawn from the market. The sales from this preparation are expected to be as follows. Year 1, casein sales would fetch you 100 million rupees. Year 2, 3, 4 and 5 cash inflows in terms of sales is given to you. You were also told in the first paragraph that presently the annual turnover is 2,200. So, here is a question for all of you all, that when I evaluate the cash flows of this project, should I look at 2,200 plus 100, that is 2,300, again 2,200 plus 150, 2,350 million as the sales turnover, or should I just look at the incremental sales, because 2,200 is in any case the current sales, and what is the additional or the incremental sales or the cash flow that I get as a result of launching this product. So, that is a question that I leave you with. You have got to evaluate that. Let us move on to the second point over here. The capital equipment required for manufacturing casein is rupees 100 million, and it will be depreciated at the rate of 25% per annum as per the WDV, which is the written down value method, for tax purposes. So, when you are told capital equipment of 100 million, this is plant, equipment, machinery and so on. In this case, we are just looking at one cash outflow in terms of an equipment or a plant to be purchased. It could be very elaborate if you are setting up this from ground zero. So, this could involve buying land, investing in construction of the factory premises and building, and then installation of the plant, machinery, furniture, fixtures, electrical equipments and so on. It could be very detailed as well. The expected net salvage value after 5 years is 20 million. So, this piece of machinery that you are buying today for manufacturing casein would cost 100 million, and after 5 years this would fetch a salvage value of 20 million. The working capital requirement for the project is expected to be 20% of sales. At the end of 5 years, the working capital is expected to be liquidated at par, barring an estimated loss of 5 million on account of bad debt. The bad debt loss will be a tax deductible expense. So, a few points over here. First of all, working capital, as we know, is current assets minus current liabilities, and once you launch this product, not all your sales is going to be on cash, not all your purchases will be on cash. So, credit sales will result into debtors, which is receivables, it is a part of current assets, and credit purchases, let us say if you are buying raw material, would result into creditors, that is amount payable to suppliers or trade creditors popularly known as, which is a part of current liability. So, a clear understanding for us is that whenever you start off a new project or a new product is being launched, it will have an impact on your working capital, right. and that becomes a relevant cash flow to be considered. Over here you are told that working capital is 20% of sales. It's an easier way of tagging and capturing your working capital as a percentage of sales. You are also told that the working capital is expected to be liquidated at par. Now, what do we mean by liquidated at par? We know that this project has a limited time span of 5 years, and at the end of 5 years, what will happen to your working capital? It will be released in the sense that the receivables would be received and you would be paying off to your creditors, and hence your current assets minus current liabilities, the working capital amount which you are investing initially will come back to you at the end of the project, except if we are saying, let us say your current assets consist of inventory and this inventory has become obsolete, so you can't sell it, then it is a loss. Or let us say there is an issue in terms of a fire in the godown and all your stock is burnt, as a result of which your current assets cannot be liquidated, you will not be able to recover that amount back. Other than that, the standard assumption is that whatever amount that you invested in your working capital will come back to you at the end of the project life. So, even if you are not told anything, so if you were not given this line, at the end of 5 years working capital is expected to be liquidated at par. Suppose this was not there, a standard assumption is that it will be liquidated at par, it will come back to you at the end of the project, right. You are told barring an estimated loss of 5 million on account of bad debt. So, your receivables, if it is let us say 50 million, 5 million of that is going to go bad. So, you will not be able to recover some portion of your receivables. Other than that, the remaining 45 million, it is an assumed amount, would be recovered, right. Let us move on. The accountant of the firm has provided the following cost estimates for KSIN. Raw material cost is 30% of sales, variable labor cost is 20% of sales, fixed annual operating and maintenance cost is 5 million rupees, overhead allocation excluding depreciation, maintenance and interest is 10% of sales. While the project is charged an overhead allocation, it is not likely to have any effect on overhead expenses as such. I will come back to this again, but this requires a little bit of discussion as we go on to calculate and estimate the future cash flows. The manufacture of KSIN would also require some of the common facilities of the firm. The use of these facilities would call for reduction in the production of other pharmaceutical preparations of the firm. This would entail a reduction of 15 million of contribution margin. Now, this is a point which exemplifies the concept of opportunity cost. You are told that when you will launch this new product, you will end up using some of the common facilities of the firm. Now, these common facilities could be production department manpower that you are using, or let us say you are taking services of the packaging department, any ancillary service department which is an existing resource which will be diverted to manufacture of KSIN, as a result of which the sales of existing products will drop, which therefore means that there is an opportunity loss happening somewhere else as a result of launching this new product. And you are told this would entail a reduction of 15 million of contribution margin. Contribution is sales less variable costs. So, you will not end up manufacturing an existing product and you will also not end up selling that existing product. So, essentially sales less its variable manufacturing cost, both would be avoided, which will result into a loss of 15 million every year for the next 5 years. The tax rate applicable to the firm is 40%. You are told calculate the cash flows for the project and calculate the NPV of the project, assuming that the cost of capital is 12% per annum. So, you've been asked to take this decision in terms of accept or reject based on two decision making criteria. One is NPV, the other is IRR, but both of these techniques, it's going to be possible once we are done with question A, which is cash flow calculation for the project. So, let's let's look at this cash flows now from two viewpoints. You know that NPV is present value of cash inflows less present value of cash outflows, which is your initial investment. So, let us try and capture the initial investment first. Let me come on to the solution, and as I said, I will keep on talking about the principles as and when relevant. So, the first step that I am looking at is the calculation of what is known as the present value of cash outflows. Textbooks and in practically bankers and financial institutions might use various terms for this step, and hence I have written everything possible under the sun over here. It can be called initial capital expenditure or investing cash flows, or it is also known as COP, the cost of the project. Right now, the cost of the project for us is only the equipment, which is 100 million. I have written it as negative essentially because it is a cash outflow. But as I mentioned to you earlier on, this could also include things like building, machinery, land, computers and so on, anything and everything that is required in terms of setting up the project, which are essentially investment in fixed assets, could come under this slot, all right. So, all of this building, machinery, land, computers, fixed asset, you have got to probably look at those breakups if the case gives you that kind of information. All right. This is the information available to me as of now. I am parking this 100 million and moving on to step 2, which is known as recurring cash flows, those which recur throughout year 1, 2, 3, 4, 5, stuff like sales, raw material, labor, that's an expenditure or a cash inflow outflow that happens on a regular basis, right. Equipment is not a cash flow that happens on a regular basis. You do it once every 5 years or 10 years. So, step 1 can also be looked at non-recurring cash flows or essentially cash outflows, all right. Step 2 is recurring cash flows, also known as operating or financing cash flows, all right. So, those cash flows which are associated with your operating decision and with your financing decision, these are cash flows which are associated with your investing decision. These cash flows are spread across 5 years in the future. So, I am looking at a 5-year analysis over here, and I start my cash flow calculation with sales revenue. Now, this sales revenue is given to you as 100, 150, 200, 150 and 100 million. I did happen to mention this when I was reading the case, but I would want to reiterate this. That is, you were given the sales of 100, 150, 200, 150 and 100 million. These are sales specific to KSIN. I ignored 2200 million over here, which is the sale from the existing product. So, let us understand a simple principle when it comes to calculation of cash flows. Let me open another sheet over here, title this as cash flow estimation principles, or give that heading over here, cash flow estimation principles. And the first principle is consider incremental cash flows, right. So, I did not look at the existing sales. What did I look at? I looked at the incremental sales that the new product is going to give. Similarly, I will also look at the incremental cost. So, I will not look at my existing raw material expenses, but I will look at my raw material expenses which are associated only with manufacturing of the new product, which is KSIN, right. So, sales revenue, let me clearly say that these are incremental sales, all right, just to exemplify this, all right. Then let us look at the remaining cash flows. I will come to point number 4 in terms of your expenses. You are told raw material cost is 30% of sales. So, when I look at incremental sales multiplied by 30%, I am obviously looking at incremental expenses. So, my cash outflow is sales revenue at 30%, which is going to be 30 million, 45 million, 30% of 200 million will be 60 million, 30% of 150 million will be 45 million, and so on. So, my raw material cost is an incremental cost that I am looking at. Then if I go back to the case, you are told in point number 4, variable labor cost 20% of sales. Please note that this is not a fixed cost, but this is a variable cost, and again as a percentage of your incremental sales, this will be an incremental cost that I am incurring only for case-in. So, labor cost at 20% would be 20, 30, 40, 30 and 20 million. That is a simple calculation. All of this is a percentage of the sales that I am taking, right. Then point 4 says fixed annual operating and maintenance cost is 5 million. Now, clearly this is an additional 5 million that I am incurring as a result of case-in manufacturing, and hence even if 5 million is a fixed cost, it is an incremental fixed cost, and hence I will not ignore it, I will consider it, and I say that it is a cash outflow, fixed operating and maintenance cost 5 million every year up to year 5, right. Hope that works. And then I come to an important point over here, which is titled as overhead allocation excluding depreciation, maintenance and interest 10% of sales. Now, we know what are overhead expenses. Overhead expenses are common expenses which are incurred at the company level, but it is very difficult to actually try and allocate them to a particular product or let us say a particular production center, and hence we go through an allocation process in cost and management accounting. So, overall these are expenses which are not relatable to a particular product. So, it could be let us say an example of an overhead expense is the rent that you pay for your factory premise. For example, if you are operating out of a rented premise, you pay rent for manufacturing all products. So, the first paragraph says that the company manufactures 16 products. So, for these 16 products plus the new one, there is a rent expenditure that you incur. Now, obviously, when you sell these products, you resort to cost plus pricing. So, you want to find out the cost of all of these 16 products, which consists of their raw material cost, their labor cost, but it also considers indirect costs like the rent cost. Now, if I do not allocate rent, which is a company level expenditure, to these 16 products, then the pricing of all of these products goes wrong. And then, if I say my selling price is cost plus profit, then the selling price that I derived is also incorrect, right. So, why do we allocate cost? Indirect cost needs to be allocated because I want to find out the cost of each product. That is what we are taught in cost and management accounting. So, it's a great concept from a costing perspective, because you want to know the real cost of the product so that you can decide what should be the selling price of the product. However, from a finance point of view, we are not looking at the cost and the income and the profit or loss. What are we trying to look at is cash flow. My question is that if this overhead expenditure is rent, do I pay any bit of extra rent because I am now manufacturing not 16 but 17 products? If the answer to this question is no, then my rent expenditure before launching case-in and after launching case-in remains the same, then rent is not an incremental cash outflow, and hence I ignore it for decision making purpose. However, if the case is that because I am going to manufacture a new product, I will require some additional space, all right, and that additional space will come at a cost. So, the landlord says you will have to pay X amount as extra rent because of this product that you are now planning to manufacture, case in, then rent is an incremental expense and I should charge that to my cash flow calculation. So, then I should be writing rent over here as an incremental cash outflow, although rent is a common expenditure, but that common expenditure jumps up because of launching a new product. Now, if you read the case carefully, it says while the project is charged an overhead allocation, it is not likely to have any effect on overhead expenses as such. So, because you are moving from 16 to 17 products, you will obviously allocate rent to all 17 products rather than 16 products. That is the costing concept. Find out the cost of the product properly. So, allocate it across 17 products now rather than 16 products. But as a result of launching this product, you do not pay a penny more. See, it says it is not likely to have any effect on overhead expenses as such. So, what you were paying as rent earlier on continues to be the rent right now, and hence it is not an incremental expense. I would ignore overhead allocation in my cash flow calculation. Now, this also is a standard assumption. What is a standard assumption? That overhead allocation is not likely to have any effect. If the overheads jump up, if they increase or maybe reduce because of launching a new product, we will consider that increment or reduction in the cost because it happens as a result of this product. However, if it remains the same, we ignore it. That is a standard assumption. Let us move on to the next one. The manufacture of casein would also require some of the common facilities of the firm, and the use of these facilities would call for reduction in the production of other pharmaceutical preparations of the firm. So, some sales out of these 16 products would go down as a result of launching this product. It could be product cannibalization, but over here very clearly it is said that it is because of using common facilities of the firm. I gave you examples of common facilities. This could be, the packaging department or any service department associated with the production department, right. So, 15 million is a contribution loss, it is an opportunity loss, it is a relevant cash flow, and I will consider it as a cash outflow, loss of contribution, right. Let me just pause over here and add to these properties. We said ignore allocated overheads. Why did we say that? Since it does not impact cash flows, right. And the third that we are saying is consider opportunity costs, that is the contribution margin that we looked at is something that we will consider. So, these three cash flow estimation principles, we see that these are being used when we are calculating the cash flows in the current case. Let me then come back to the case and come back to the working capital point. No, the second point over here, that the capital expenditure is 100 million, we have recorded that, and it will be depreciated at 25% per annum as per WDV method. So, if I deduct all of these costs, I will come down to PBDT, and if I deduct depreciation from that, I will come to PBT. From that, if I deduct tax, I will come to PAT. So, the first step in my cash flow calculation is to be able to calculate the profit accurately, and after having calculated the profit, we move to cash flow calculation, right. Now, this will entail looking at depreciation, this will also entail looking at working capital, right. Let me first of all look at working capital and then come back to the other aspects, or let me look at depreciation first. That seems to be the point that I read, 25% WDV. So, here is a small working note on depreciation calculation. right. So, we know that depreciation is going to be for 5 years, because that is the value, and the opening value of the asset is 100 million. 25% depreciation on that would be 25 million. So, the first year's closing value will be 75 million, which happens to be the second year's opening value. On 75 million, 25% depreciation will be 18.75 million, resulting into a WDV of 56.25, so on and so forth. So, my depreciation for a period of 5 years happens to be 25, 18.75 and so on. This is a cell that I link in my cash flow calculation up there. So, this cell comes over here in my cash flow calculation, profit calculation, depreciation, and I deduct my depreciation from PBDT, profit before depreciation and tax. So, the sales was 100 million. From that, if I deduct all these expenses, 30 million of raw material, 20 million for labor, 5 million for operating and maintenance cost, and 15 million of contribution margin, what am I left out with is a PBDT of 30 million. So, 30 million less 25 million of depreciation gives me a PBT of 5 million. I am also told in the case that the tax rate is 40%. Now, that is also a question, that when I look at cash flows, should I look at taxation? The answer is yes, because tax is a legitimate cash outflow, an operating cash outflow, and hence it needs to be considered. So, I look at 5 million multiplied by 40%, which comes to 2 million. So, let me write over here tax at the rate of 40% for your clarity. That gives me a PAT of 3 million. So, profit after tax of 3 million is what we have calculated, and on similar basis I would urge you all to go through the Excel sheet and look at the PBDT, less depreciation and less tax for all the years. That is a calculation which is an easy calculation, and you should be able to come to the profit after tax, right. So, that is the PAT for 5 years, and then we move on from PAT to cash flows. Now, if you look at all the expenses and incomes over here, one expense stands out, which is depreciation, and you know that depreciation is a non-cash expense, right. So, this is not something that you have paid out of your pocket, and hence it is a non-cash expense. I need to add this back to my profit in order to come to my operating cash flow calculation. So, what am I doing is, after deducting the depreciation, I am adding it back to the PAT calculation to come to what is known as operating cash flows. I hope this is clear, that 3 million plus 25 comes to 28 million. 3 million was my PAT, 25 million was the depreciation that I deducted earlier on, but now I am adding it back to come to the cash flow. Now, some of you might be thinking that if I had to add back depreciation of 25 million over here, this cell is what I am referring to. If I had to add it back, why in the world did I even deduct it? I deducted it in the first case primarily because I wanted to calculate the correct PBT, because if I have the correct PBT, then I also have the correct tax, right. So, we deduct depreciation for the profit calculation, we add back depreciation for the cash flow calculation. Hope that is clear. Now, let us look at the working capital point. Let me read this point one more time. You are told that the working capital requirement for the project is expected to be 20% of sales. At the end of 5 years, this working capital is expected to be liquidated at par. Explained this earlier, that the standard assumption is that what happens to the money that you invested in working capital in the beginning of the project, at the end of the project it comes back to you, because the assumption is that all inventory is sold, the assumption is that all receivables, the money from your debtors and your customers, receivables, is received, and you will end up making the payment to the creditors or suppliers. So, the net cash flow which is tied up in working capital in the beginning of the project comes back to you, is released at the end of the project, right, except for certain losses, like you were told estimated loss of 5 million on account of bad debt, right. We will consider this as we move on. So, let me calculate the working capital for you first. That is a working note on working capital. Again, we do a 5-year calculation, and we also look at year 0, because year 0 is today, and today is when you start off the project, and today is when you invest the money for working capital. But let us just look at the working capital calculation first. You were told that working capital requirement is 20% of sales. So, 20% of sales is linked in this manner. We are saying 20%, that is the reference cell, multiplied by the sales of year 1, 100 million. Similarly, I have done a calculation for all the years. The cell reference, for example, for the 5th year looks like this, that is 20% multiplied by the sales of the 5th year, right. Now, please note that this is the level of working capital which is required. What do I mean by level? This is the quantum to be maintained in the system, that is in the business, for you to be able to carry on the business in an uninterrupted manner. How do we calculate the cash flows from this? I am saying my working capital cash flow will be minus 20. When I say minus, means it is an investment. Where does this come from? It comes from my requirement of the first year. So, the first year I need 20 million as working capital. How do I get that? By putting in the money. So, it is a cash outflow for me in year 0. If I invest 20 million in year 0, I will have 20 million at the end of year 1 in my system, which will help me in my day-to-day working. So, working capital is the cash that I require for day-to-day working. So, 20 million is a cash outflow, and this 20 million, since it pertains to year 0, right, I am showing this as a part of year 0, step 1 over here, right. So, 20 million initial working capital, which gives me my total cost of the project as 120 million. So, whatever I invested in year 0, I do not need to discount that cash flow, it is already in present value terms. Similarly, this 100 million for equipment is already in present value terms, so I do not need to discount it, and hence I took it to year 0 and I added it. So, my total cost of the project comes to 120 million rupees right now. I have already looked at 20 million as a cash outflow. Now, when I say that the working capital for level year 1 is 20 million and I need 30 million as working capital level in year 2, how much do I invest in year 1 in order to get to a working capital level of 30 million? So, the question is, for this 20 million, I invested 20 in year 0. So, the level of working capital, which is current assets minus current liabilities, at the end of year 1 in my business is 20 million. If I want the level of working capital to go to 30 million, I will have to invest something at the end of year 1, so that at the end of year 2, it goes up to 30 million. Conceptually, the question is, do I bring in an entirely new amount of 30 million, or do I bring in only an incremental amount from 20 to 30, that is an additional 10 million. I hope my question is clear. I will repeat it one more time. my working capital level should be how much? 30 million at the end of year 2, all right. To get to 30 million, should I get, just as a way to get to 20 million, I got how much? 20 million in year 0. Should I invest 30 entirely new at the end of year 1, or should I just invest the incremental? The answer to this revolves around the understanding of what happened to this 20 that I brought in year 0. Do I ever consume working capital, or does working capital always remain in the system? Does working capital always keep on rotating in your system, or does it get evaporated, in the sense that does it get consumed, right? Like working capital changes form. If you invest in cash, you convert it to raw material is converted to finished goods are sold, converted to receivables once you get the money is converted again to cash. So please understand that when you invested this 20 million and you reached a level of 20 million, this rotates in your business. It keeps on changing form, but it does not disappear. It does not get evaporated. It is not consumed. So now, with this understanding, if I have working capital in the system because it is not consumed of 20 million and I want to move to how much? 30, I need to bring in only an additional 10 million. So that's my investment cash flow in year 1. That's a cash outflow, and it's a function of these two cells. So you can see the cell reference, it is D47 minus E47. So it is this column less this column. So it's 20 minus 30, showing a negative 10, which basically means a cash outflow. It's an investment, right? Then if you look at the next year, from 30, the working capital level needs to go up to 40. So the working capital needs to increase. An increase in working capital means you'll have to pump in money, all right, which is again a cash outflow. So at the end of year 2, you need to invest an additional 10 million, which is 30. An additional 10 that you invested gets you at 40, all right. Then if you start looking at year 3 and 4, if you mark it carefully, this is not an increase in working capital. From 40 to 30, it is a reduction in working capital. A reduction or a decrease in working capital is not a cash outflow, it's a cash inflow, because some working capital is being released into the system, right. So this formula again remains the same. It is cell F minus G, but it is now 40 minus 30, resulting into a cash inflow of how much? 10 million, right. Again, if you look at year 4 and 5, it's a reduction in working capital. From 30 million, it goes down to 20 million. So 10 million is positive again. It's a cash inflow. I repeat, reduction in working capital is a cash inflow. Increase in working capital is a cash outflow. So when it increased from 20 to 30, it was a cash outflow. 30 to 40, it was a cash outflow. But when it reduced from 40 to 30, it resulted in a cash inflow. Again, from 30 to 20, it resulted into a cash inflow of 10 million. Now, at the end of 5 years, what is the working capital that we have in the system? 20 million. What happens to this 20 million? The project has come to an end, you've wrapped up. This 20 million is there in your balance sheet in the form of current assets minus current liabilities, which is inventory, receivables, less payables or creditors. The standard assumption, as I told you, inventory is sold off, receivables are received, you paid off your creditors. So this 20 million, after paying off your creditors, is the surplus amount left with you, current asset minus current liability. All of it comes back to you, right. So ideally, I should be writing 20 as a cash inflow in year 5, right. But I am not writing 20 over here. In this specific case, I can go back to the case and read this. You are told working capital is to be liquidated at par barring an estimated loss of 5 million on account of bad debt. So, I should actually be writing 20 minus 5, 15, right. 15 million is my actual cash inflow and not 20 million, because out of my receivables 5 is what I lost on account of a debt going bad, right. However, for a moment I choose to write 20 over here. I will explain that in a bit, right. I hope the cash flow calculation as far as working capital is clear. Out of these cash flows, I have already given an impact of this 20 million, I repeat, of year 0. I have written that over here in step 1 as a cash outflow, which increases my total cash outflow to 120 million. What I have to now incorporate is these cash flows for year 1, 2, 3, 4 and 5, and I will have to talk about that 5 million separately again. As of now, I have not brought this 20 minus 5 down to 15. I have chosen to write this as 20 right now. Okay. So, this is year 1. What do I do is, after my operating cash flows, I write changes in working capital as 10, negative 10, negative 10, positive 10, 10 and 20. And if you look at the cell reference, all of this cell reference is from the working note. Just a moment. Yeah. So, the working note, this minus 10, minus 10, 10, 10 and 20 leads you to your changes in working capital as a cell over here, right. I will come back to this point now. I have written 20 over here instead of writing 15, because the amount that came back to me is only 15 million and not 20 million. 5 million was bad debt. If you read the case, you are also told that the bad debt loss will be tax deductible expense. Now, what do I mean by a tax deductible expense? That like salary, wages, rent, administrative, all of these expenses will go on to determine my PBT, and my PBT is the amount on which I pay tax. So, if I deduct 5 million as bad debt, in my profit calculation, my tax amount will go down, and that is exactly what I want to do. After this loss of contribution, what I have done is, I have written bad debt, and there is no bad debt in year 1, 2, 3, 4 and 5, I mean year 4. Year 5 has a bad debt amount of 5 million. So, what this does is, it brings down my PBT to 25 million. So, 100 minus 30, 20, 5, 15 and 5. So, my PBT is not 30 million, but it is 25 million, as a result of which my tax calculation is 6.84, because I am calculating tax on a PBT of 17.09. So, if I now look at my net impact, I showed an inflow of 20 million over here in the last year, and I am showing an outflow of bad debt of 5 million. So, 5 as an outflow, 20 as an inflow, the net impact has come down to 15. The problem with showing 15 over here, either in the working note, so if I change this to 15 like this manually, and this amount also changes to 15, then please understand I cannot show 5 million as bad debt before PBT, alright, because I can't be writing 5 million as an outflow 2 times, once over here 20 minus 5 and another time along with all other expenses. If I write 5, then I am double accounting it. So, that is incorrect. Because I want to write 5 million before PBT, because it is a tax deductible expense, I choose to write this 15 not as 15, but as 20, right. So, that is the presentation bit of it. If I do not present my bad debt 5 million as an outflow over here, then my PBT goes wrong. If my PBT is incorrect, my tax is incorrect, and so is my operating cash flow going wrong, right. So, I show 20 as an inflow and 5 as an outflow. Last bit now, I have changes in working capital, incorporated that. The last thing that I am looking at is point number 2, the last statement, that is the expected net salvage value after 5 years is 20 million. So, this machine that we bought for 100 million, right, would be sold off at a scrap value of 20 million, which is something that I get only at the end of 5 years. So, salvage value of the equipment is 0 in year 1, 2, 3, 4. Year 5, what do I get is 20 million. Now, I have kind of considered all the cash flows. If you go through the case, which is always a good thing to do, go through the case in its entirety, watch out for things that you've forgotten, that you've not looked at, and then try and close this. I have looked at sales, I have looked at equipment and its depreciation and salvage value. Point 3, I have looked at working capital and bad debt. Point 4, I have looked at raw material, variable labor cost, fixed annual operating cost. Overhead allocation, I told you it will be ignored, gave you the logic for that through the rent example. Point number 5, opportunity cost, that is reduction of contribution of existing products. And point number 6 is taxation, we have considered tax. Let me add that as a point to my cash flow considerations, that is consider after tax cash flows, right. So, these are 4 points that we have looked at till now, considering incremental cash flows, considering opportunity cost, considering after tax cash flows, and ignoring allocated overhead costs. Let us now close the case by looking at the final cash flow calculation from an NPV and an IRR perspective, right. So, let me look at the cells from here. My operating cash flow was 28, 40, 53, 37 and 18.16. In that, I either deduct, because it is minus 10, or I add the working capital cash flows because it is plus 10, 10 and 20, and salvage I add only in the last year. This would give me my total cash inflows. So, 18 is 28 minus 10, right. 40.5 minus 10 is 30.5, 53 plus 10 is 63.3. Why did I add 10? Because the working capital was a positive cash flow, it was a cash inflow. Similarly, 37 plus 10 is 47.22, and in the last year we add 18 plus 20 for working capital and plus 20 for salvage value. So, my last year's cash flow is 58.16. So, that is part A, that is calculate the cash flows for the project. Now that we have the cash inflows and the cash outflows in step 1 and 2. So, step 1 was cash outflow, I can name this as present value of cash outflows, right. Why am I calling this as present value? Because all of this is supposed to be year 0, I do not need to discount it, no PVIFs required, right. However, these cash flows are future values and all of these need to be discounted to the present. So, the NPV calculation looks like this. I have said PVIF at 12%, that is an assumed rate over here, because you are told calculate the NPV of the project assuming that the cost of capital is 12%. So, your minimum expectation of return is 12%. I use a PVIF of 12%, you know the formula by now, 1 upon 1 plus r raised to n, multiply that and we get the present value. So, 18 multiplied by 0.893 gives me 16.01, and then I add all of these cash flows to come to the total present value as in year 0, right. So, my total present value of cash inflows is 148. It's a summation of all of this, 148 million to be precise, less my total cash outflows were 120 million. That's from step 1 over here. So, 148 less 120 million gives me an NPV of 28.68 million. So, at a 12% cost of capital, the NPV is positive, and hence NPV as a decision making criteria tells me that you should accept the project. It is going to add to the shareholders' wealth. So, that is one part of the solution, and then we look at the IRR calculation, which is also simple given the IRR inbuilt formula in Excel. So, all that I am doing is I am representing the years over here. Cash flows we have already calculated. So, I am just reproducing the cash flows. Cash flows are as follows: year 1 is 120 negative, which is from step 1 over here, and year 2 is 18, that is the cash flow. Let me just highlight it in another color. So, 18 gets reproduced over here, it is the same. The cell linkage is also very clear, that is where it comes from, and 58.16 for the last year also is from the same cash flow calculation. So, now that we have the negative and the positive cash flows, all that we do is look at the inbuilt IRR formula for looking at the IRR calculation, and once I use the inbuilt formula, I get a 19.73% as the internal rate of return of the project. Earning a 19.73% return on your cost of capital of 12%, the IRR rule is simple. If your IRR is more than the cost of capital, you go ahead and accept the project. So, both from an NPV and an IRR perspective, this is a project that you go ahead and accept. More important than the application of the NPV IRR decision making rule is the cash flow calculation in this case, which is essentially this table that we have calculated as step 2 over here, right. That's the important calculation, which is cash inflows, and for this we went through the following 4 cash flow estimation principles. There are more principles as well, but we can discuss them as we move on and as we tackle other cases, but these by far are the most common and the most often repeated cash flow estimation principles. I hope the NPV and IRR calculation is clear through the Excel sheet. I will urge you all to go through the sheet, the cell linkages, and happy to answer any of your questions. Thank you.